Hello, Market Insights watchers. In Market Roundup, jobs and consumer sentiment numbers are in. Find out why one Wall Street investor sees stocks as ripe for further gains in 2024 as inflation trends lower. And tech megatrends, CES 2024 kicks off in a few weeks, and we have exciting EV preview to share with you. And in Crypto Corner, Ian answers several great Market Insights mailbag questions that have come in. Plus, he's going to delve into Google's new Gemini AI model to share a preview of what's happening there. So until then, let's get started. Hi, Ian. How are you today?
I'm good, Amber. Just getting into the holiday spirit and also trying to not be the last person in my neighborhood to put up Christmas lights this year.
Yeah, don't be the last one. Yeah.
I'm like, if you put them up late, then you can keep them until like February, right? Isn't that the rule?
It's
No?
whatever your heart desires. Some people love Christmas year round, so whatever you want to do is fine.
We did get a tree, which I think like early December, maybe it's a little too early. I'm afraid by Christmas time that like there's not gonna be any pine needles left on the tree, but we'll see.
Hopefully it'll hang in there until the holiday is over. But
Literally hang
yes,
in there.
hang
Okay.
in there. Oh my goodness.
Hold on there. Okay.
So we'll begin with a market roundup. The November jobs numbers this past Friday showed U.S. employers added more jobs than expected, and the unemployment rate, well, unexpectedly fell to 3.7%. And all stocks moved higher on rock-solid jobs data and consumer sentiment information, underpinning the hope of an economic soft landing. Non-farm payrolls increased to 199,000 following 150,000 advance in October. Returning auto workers who were on strike actually helped boost that count by 30,000. Healthcare hiring in November spiked. Healthcare added 77,000 jobs from hospitals to nursing homes and residential care facilities, all while the labor force participation rate, the share of the U.S. population that's working or looking for work, picked up to 62.8%, matching post-pandemic's high. Now, this is a number the Fed really likes to see. The cherry on top was the results from the household survey. Now, the jobs report is comprised of two surveys, one from households and one from businesses. And households added a stunning 747,000 jobs, hence the drop in the unemployment rate from 3.9 to 3.7%. So what does this all mean? What does it mean? Well, the view is that while economic strength lessens fears of a recession amongst consumers, it may foretell that the Fed might have to hold rates higher for a while longer. And Ian, a separate report from the University of Michigan showed U.S. consumers' views on inflation are heading in the direction that the Fed wants to see. U.S. consumer sentiment rebounded sharply in early December, actually exceeding all forecasts. Per Bloomberg, it showed consumers, quote, dialed back their year-ahead inflation expectations by the most in 22 years. So a lower inflation expectation, the Fed welcomes that. And lastly, as you've mentioned, Ian, in previous webinars, a staggering amount of cash is sitting on the sidelines still. Investors are sitting on $5.8 trillion in overnight funds. And according to David Balin, a Citi Global Wealth's chief investment officer and head of investments, quote, stocks are ripe for further gains in 2024 as inflation trends lower the economy. It actually remains resilient and earnings rebound, increasing the opportunity cost for investors still sitting on the sidelines, clinging to their cash. And he goes on to say, I'm not sure what investors are waiting for. The US economy is going to stay strong, and eventually money market rates are going to come down. So why are people not buying core 60-40 portfolios, end quote. And just so you know, everyone, if you're not familiar, 60-40 portfolio is simply a strategy that allocates 60% to stocks and 40% to bonds. So Ian, what's your take? What do you feel about these numbers?
Well, you shared a lot of information with us there, Amber. Thank you for that. That was jam-packed. First things first, the job number came in a little bit better than expectations. Initially, Friday morning, the market pulled back a little bit and then rallied. What that's telling me is the market wants to go up. The trend is your friend right now. We've been heading up since early November when we bottomed. We've been calling for a year-end rally. There's no reason right now, at least from that economic indicator, that this would be derailed. Interest rates have gone up about in the 10-year about 15 basis points, not very much. Consider they've gone from basically 5% on the US 10-year all the way down to 4.1% in about a little over a month. And the other thing too is that rate hike expectations are still not showing the Fed is going to keep raising rates. Remember, that was the worry a couple months ago when the market was selling off, that the Fed might actually have to raise rates. But we've seen some weaker than expected inflation data come in. And, the market has turned to either the Fed's going to be on hold for the first quarter of the year, or they could cut. It's about 50-50 right now. And there's nothing in the jobs number that changed that equation. So the trend is still your friend. The trend has been up. And then also, the market right now, the S&P 500 is trading with about a 21 price earnings ratio. So from a valuation perspective, that's a little bit high. The average is about 19, going back to 1989. However, it's higher because of what you call the Magnificent Seven, the 7 gigantic tech stocks that really have led the way this year, that are trading at a higher PE than the rest of the market. But I do think you're going to see those giant tech stocks start to kind of not top out, but plateau. And you'll start to see hedge funds and traders taking gains from that and moving into the smaller and mid-cap stocks, which we've been seeing a lot of it this year. Small and mid-cap has especially in growth, has significantly outperformed anything, every other sector except for crypto, of course, in the last month. And I think we're going to see more of that into year end.
Okay, well, that's a great forecast to watch. So let's switch gears to tech megatrends, everyone. And tech megatrends CES 2024 kicks off in Las Vegas, Nevada on January 9th. And I have a preview for you. An all-new global Honda electric vehicle series will make its world debut at CES 2024. According to the company's press release, quote, toward its global goal to achieve carbon neutrality for products and corporate activities by 2050, Honda will introduce 30 new EVs globally by 2030 with a global sales volume of 2 million units. In North America, Honda has laid out an aggressive timeline of EV introductions leading to 2030 and ultimately to 100% zero-emission automobile sales by 2040, which includes battery electric and fuel cell electric powered models. And at its booth at CES, through its dedicated CES 2024 website, Honda will showcase the global EV series models in several key technologies that illustrate the significant transformation Honda is currently undergoing, end quote. So 30 new EV models by 2030 is an ambitious number, but looking at demographic statistics as of May of last year, 55% of consumers age 18 to 29 and 47% of those age 30 to 49 stated they are likely to buy an EV versus 34% of those 50 and over. And a survey by Pew Research pointed out up to 56% of millennials and Gen Z respectively favored phasing out new gas-powered vehicles. So the consumer buying power appears to be there. So I'm just looking forward to seeing how this Honda EV debut goes and more CES 24 just variety of new inventions coming out next month. So Ian, how do you feel about this EV news from Honda? Just 7 years, 30 vehicles. Oh my goodness.
Yeah, it's really been a race to the $25,000 EV. And something that's a viable EV. There are sub $20,000 EVs in China, but they're not cars that you really want to be driving around. They're much smaller than let's say a Tesla Model 3. And I've heard Elon Musk recently talk about that's been their goal actually for 4 or 5 years now, is to get a mass market EV, even more so than the Model Y, which a Model Y, which is a mid-size SUV, after the tax credit, the base model is something like $33,000. So it's like they're not very far away in terms of getting there in 25. And I think it's like $31,000 for the Model 3 if you get the base model and then you apply the tax credit to it. I think this competition is just great. And also it has a flywheel effect in the sense that, yes, the charging infrastructure is not great right now, but a couple of things that are happening in the next year, everybody's going to go to Tesla's, charging standards. So if you drive an EV made by Nissan, or Ford, you can now charge on Tesla's charging stations. And the second part is that as more EVs come out and there's more demand for charging stations, there is more incentive for businesses and apartment complexes to add that charging station capacity. So I think that like the infrastructure problems eventually will be solved and people won't have as much range anxiety as they do now. I mean, if you need to drive up and down the East Coast or throughout parts of the Midwest on a daily basis, an EV is not for you. But if you live in a suburban area and you're a city, more likely than not, the charging infrastructure is good enough for you to be able to get around that area. So I think that's great news from Honda, and I really look forward to seeing those cars.
Oh yeah, I totally look forward to it.
And also Honda's not like I feel like they were displaced a little bit by Toyota over the last couple of decades. Like 25 years ago, Honda was like sort of the go-to, more reliable foreign import car. And I think there's a little bit more competition now. And so, it's good that they seem to be stepping forward with something new to the market.
Right. Looking forward to seeing.
Of course, you won't be driving an EV anytime soon, Amber, right? Because you love your muscle cars.
I love
unless they put like some noise in it for you.
Well, I have found the muscle car, and it's a Dodge Charger. I don't know what year. I guess it's a 2024. I sent it to the team, and it has it's electric, but it has the rumble of the engine sound and everything. So that really made me happy. So we'll see when that comes out. I'll let you know.
Well, I got to tell you, as someone who's driven quite a few EVs, the one benefit as a passenger you have in a car that's loud is you can anticipate when your neck is going to get thrown back. In an EV, it's very silent. You just kind of get jolted around. And because you don't hear the engine rumbling before the car goes, it just goes when you step on the pedal. So maybe that would be a smart thing for them to add to the EV, so passengers can be aware that you're about to go from 30 to 50 miles an hour instantaneously,
so they can brace themselves. I think that's a great idea. Okay, everyone, in Crypto Corner, we have several great questions to get to, but first, Ian, take it away with what's happening in Google.
So thank you. The first things first, CNBC is now talking about the Bitcoin halving. And, I don't want to toot our horn too much, Amber, but this is something that we've been talking about as a significant event for Bitcoin for at least the last 3 or 4 months. CNBC now covering it. You've seen the price rise of Bitcoin, so everyone's excited about it. What's going to happen, so everyone knows, is that every 4 years or so in Bitcoin, the protocol switches the reward mechanism by half. So instead of getting paid, initially it was, for every block you mined, if you were the lucky miner, you got 100 Bitcoin, and then you got 50 Bitcoin, then you got 25, and then 12 and a half, and now it's going to move to 6.25. And what it means is that there's going to be less supply paid out to miners on a daily basis. So think of it like if you were looking at the price of oil and knew that on a certain date, the world's oil supply, or at least how much they were plumbing on a daily basis, was going to be cut in half, right? You would imagine the price would going up because the supply is getting cut in half. And it's a very psychological factor that has led to pretty significant rallies in Bitcoin, and has really driven the whole crypto super cycle, right? So we had a halving that happened back in 2020. And, we all know Bitcoin went from about 3,000, the lows in 2019, to about 70,000. We had another halving in 2016. It took about a year for it to really get going. But at that time, the price was about 800. By the end of 2017, it was at 20,000. And, there were other halvings before that in 2012. And so this is a similar cycle to that. And for me, it's like, wow, CNBC is not talking about it. So everyone is hearing about this finally. And hopefully we're able to get some Bitcoin before you hear the news reported on CNBC. Not that it can't go up anymore, but it's just, the news is out there. People know this. But the other piece of news that I want to cover, and this is pretty significant. There's rumors going around, and these aren't confirmed, that Qatar's sovereign wealth fund is considering a $500 billion investment in Bitcoin. Now, there are a lot of oil-rich, dollar-rich countries in the Middle East. And, you can only imagine sort of what's happening here in the United States, that some of these countries might want to diversify their reserves. A lot of the central banks around the world hold a lot of dollars, right? And it's a store of value when there's global chaos around the world, people go and buy dollars as a flight to safety. If there is problems in Europe, like there were during the debt crisis, you saw the dollar appreciate strongly against the euro. The dollar has been up, significantly against the Japanese yen ever since the 1980s. And we're starting to see the dollar rally also against the Chinese yuan. This is really interesting to me because for the first time, you're talking about major central banks that would be adding this as a diversifier. Now, we've seen a couple countries like El Salvador adopt a Bitcoin standard. And you're also hearing rumors in Argentina that the new libertarian president wants to get rid of the central bank and then go on a dollar standard. And he's a big Bitcoin supporter as well. So I don't know if this is true, but it would not surprise me in the very least that this happens in the next couple of years, where I'm not saying that these sovereign wealth funds or these central banks are going to put their entire investment in Bitcoin, but 3, maybe 5%, and that would move the needle significantly. What I've been hearing is that if Qatar is actually doing this, you could see the price of Bitcoin go well over 100,000, not just because of the demand for Bitcoin, but also because of the psychological impact that it would have. In the longer term, how many other central banks are going to be buyers of Bitcoin? And then it almost like there's going to be a race to acquire it if this starts happening, and they all start to follow one another because nobody wants to be the last person to actually buy Bitcoin as a hedge to their reserves. So to me, that is just huge news, and also just another piece of evidence that the space is poised to go higher from here.
Wonderful. Okay, Ian, speaking of Bitcoin, we have several questions that have come in regarding some cryptos. The first is from Art, who follows us on Twitter. And Art wrote, "Hey, Amber, I'm finding out BlackRock is buying Bitcoin directly from miners and putting it into cold storage. In return, it doesn't affect the price of Bitcoin or the miners. Any insight on this? Thank you."
Oh, great question. Thanks, Art. Just so we can address the nomenclature, BlackRock is the company that's an asset manager that's creating an ETF, an exchange traded fund. In order to issue an exchange traded fund, they have to actually have the Bitcoin on hand, right? When you have an ETF, it's basically security that's based on an underlying asset, right? So if you have an ETF that's based on gold, the asset manager that issued the ETF has the gold equivalent in storage somewhere. So same thing with Bitcoin. For them to issue an ETF, they have to acquire the Bitcoin and put it in what's called cold storage, which means that it's on a hard drive. It's not connected to the internet. The risk of it getting hacked is very low. And what Art is asking is that he's hearing that BlackRock is buying directly from miners. And the way this works is that there are a network of miners, which are these computers that are basically adding new transactions to the network and making sure it's secure, making sure nobody can actually take down the network. And in doing so, remember, they're getting rewards in Bitcoin. So these miners are always acquiring more and more Bitcoin, and a lot of them just keep a store of them. And this makes sense to me, because what BlackRock would want to do, instead of disrupting the market by like going into Coinbase and trying to buy $10 billion worth of Bitcoin, which would make the price shoot up, to 500,000. They're doing basically over-the-counter trades. So in this sense, what the asset manager would do is they call a bunch of miners and they use like an over-the-counter desk like XBTO, which sponsors. You might be familiar with that. XBTO, they sponsor the Miami soccer team that Messi plays on now. So you might have seen that on the pink jerseys. And what XBTO does is they call the miners and they say, hey, BlackRock wants to buy $100 million of Bitcoin today. Could you sell us 10 and give us a price on it? And then they negotiate, where the market is that day, how much extra they'd have to pay to get that liquidity. And, they give basically BlackRock a price and they say yes or no. This is how most bonds are traded on Wall Street trading desks. They're not put on an exchange like that. The price is actually negotiated through a bunch of people. And this seems to be what's happening, because if BlackRock wants to issue an ETF, they have to acquire all this Bitcoin, and doing it on the open market, with the markets basically as thin as they are right now, and how much BlackRock needs to acquire in order to get this ETF going, it makes more sense they would buy directly from miners, because miners have the supply. And so, yes, I do believe that is what's been happening behind the scenes. And there's also driving price up, because people hear like, hey, BlackRock just paid, $44,000 for 100 million Bitcoin. The price is going to follow that. I mean, those news kind of like go around crypto trading desks.
Okay. All right. John K, a lifetime subscriber, Ian, has written in and says, for those wanting to invest in Bitcoin ETF, will you be recommending one of these? How soon after approval will you make this recommendation? Please advise. Thank you.
Yeah, you should have exposure one way or another through Coinbase, or if you can't have a Coinbase account, GBTC is something that we've owned and recommended in Strategic Fortunes. But I think BlackRock ETF would be the way to go, because I don't know, they feel safest way, not some startup ETF issuer. I would be a little more worried. Like, I know BlackRock will spend the money to make sure that nothing can go wrong, because there is risk. There's two risks in crypto that a lot of people need to consider. Number one is the capital risk, the fact that the price of the crypto asset could go down. And there's also a security risk, right? The fact that somebody could hack into your wallet or your account and steal your cryptos, and you have no recourse. It's not like you can call the credit card company and say, hey, somebody stole my credit card and bought $5,000 worth of luxury clothes. And the credit card company just credits you. That's not what happens. A crypto transaction is a final payment. Once it's moved out of your account, it's gone. And so that's the second risk in crypto that we always talk about in Next Wave Crypto, that people need to be aware of, and ways that you have to protect yourself. But buying an ETF would be much better protection than, let's say, buying a Bitcoin and trying to hold it in cold storage on your own.
Good point there, Ian. Okay, Denny G asks, I know that altcoins usually begin to move up after Bitcoin and Ethereum begin their move, and this has already begun. My question is this: when does altcoins tend to begin to top out in the cycle?
Wish I knew. That's a great. So I've had this conversation with my peer group recently, Amber, and we talked about this phenomenon that I've observed throughout different cycles, where it's like the money comes in first in Ethereum and Bitcoin, and then it starts to move into like other altcoins. That is common knowledge. Like everyone knows that's going to happen. So what we've seen this cycle is actually the altcoins have moved up more than the larger cryptos have, like Ethereum, Solana, and Bitcoin. So that's why, like, in our Next Wave portfolio, we keep an allocation to these altcoins at all time. You don't have to put 50% of your portfolio into an altcoin, but if you structure it in a way that you do have exposure to altcoins, you don't really have to worry too much on when the altcoin cycle is going to start, because you're already in. And yeah, this is a different cycle than we've had in the past, where it's like Bitcoin, Ethereum go up 5x, 10x, and then all of a sudden the altcoins start moving. Now it's like, as soon as the Bitcoin started going up, all the rest of the altcoins went with it. And I think it's just because everyone knows that altcoins go with Ethereum and Bitcoin, and they just go, move. It's kind of like the market. If you see Apple go up 10%, every other stock is going to go with it as well. And the same phenomenon is true in crypto. Now, there are also other undiscovered parts of the crypto market where the money hasn't necessarily flowed yet. But in general, let's say the top 200 altcoins have already moved up significantly over the last couple of weeks.
Wow. Okay.
I don't know when it's going to top, Amber. That's a great. I didn't even answer his question. Like, the thing is about the crypto rallies that people need to understand is that, we've been through like 18 months of like sideways consolidation. And what happens during that is there are sellers who don't have a long-term view of the space that are selling to people who have a longer term view, right? And Amber, let's say you go sell Bitcoin right now. You're expressing the belief that you don't think that it's going to be higher in the future. The person buying believes it's going to be higher in the future. Right. And, people have been sitting on this kind of sideways market accumulating. And we all know that when crypto starts moving, it goes up a lot, right? So no one sells on the first 10% or 20% or 50% move. And then you have all these other people that are coming in saying, I better buy in now because now it's finally moving at the same time that no one wants to sell. And that's how you get these super spike rallies in the asset, because everybody wants to buy at the same time. And also, like, the people who held for 18 months or who have been holding for years, like, they're just not going to sell to you. Sorry, and that's why I think, like, always keeping some type of minimum allocation to the space is the best way to go, rather than trying to time when to get in and when to get out. So the last thing on how high it can go, well, in the 2017 Bitcoin cycle, I remember I wrote an article for Investopedia in the summer about how the Bitcoin super cycle is here. It was like at $3,000 at that point, and we had a big sell off. It was down 20%, and I said, this is, my thinking was a sell off in terms of, but it was going to larger rally ahead. The predictions that I was seeing at the time were that it would triple by the end of the year. Okay, from 3,000 to 10,000. We got to 10,000 in like late October, early November, and then it doubled again like the next month.
Wow.
So it's like whatever expectation you have, it usually goes way past it on the upside and also the downside, right? That rally that we had in 2017 was followed by like a 80% sell-off in Bitcoin and 95% sell-off in Ethereum. I mean, yeah, trim, get out of it, get back yourself back down to that initial allocation. But, understand how these cycles work. Like, once the cycle is happening, it's just, hold on to your seats and make sure your seatbelt is securely fastened, Amber.
Okay.
Yeah. Well, and it's like one of those rides, like, they put those things on you, those like roller coasters where it's not like a lap buckle anymore. It's like they put the harness over you. And
right.
When you sit, you ever have that uncomfortable feeling where it's like, I don't know if you ride roller coasters, but like, it's like it's moving just a little bit too much, and you're like, I wish this could be just a little bit tighter, so I didn't have like this. You feel like if it moves a little bit, it's gonna pop off. Anyway,
fall out. Yeah,
that's the most terrifying feeling, riding roller coasters.
The last roller coaster I rode will be the last roller coaster I ride. It was.
Oh, you're not a roller coaster fan?
I love roller coasters up until the last one I went on, and it was so scary. I said, "Why am I on here? Let me get."
Was it a wooden roller coaster?
No.
Those are the scariest to me.
It was. I hate to say, it was at SeaWorld, and I loved it. Don't get
me wrong.
But it was just too high and too many loops. I'm like, okay, I'm over this. So. Too old.
Yeah, the modern ones are not that bad. If you go on like the old school ones, the ones that like are made of wood, and like the safety precautions weren't the same back then, and you're not sure whether or not some of the supports have rusted. That's definitely the safety thing is more terrifying for me than the heights and the drops.
Okay, well, that's a good point.
But I'm a big roller coaster fan, so
okay,
we'll agree to disagree.
Exactly. No, I've always loved them, but that one scared me quite a bit. But it's okay. Okay, everyone, right. But those are great questions, Ian. Great answers from Ian. Great questions from Denny G, Art, and John K. Thank you so much for writing in. And thank you, everyone, for watching. And know that
one more thing.
One more thing. My bad.
One more thing. We're going to include a link to this. Google released just an incredible AI demonstration this week. It's called Gemini. A year ago, Amber, we started talking about ChatGPT, and that was fun. You could write like Shakespeare poems about people, and you could write a Bob Dylan song, about walking the dog or something like that. Now it's like with the new Google release, it's like Gemini can actually watch what you're doing. So they show a video where the guy is drawing a duck, and the algorithm is telling him what it is. One caveat, though, Amber, we discussed this, is that video was edited to show that there was no latency. So it actually works a little bit slower than you see in the video, but when you see the video, you can see the power of this and kind of start to see where we're going with AI. And it is really exciting to see how this is developing in real time.
Oh, that's awesome. We all look forward to watching that video. So please be on the lookout for that link in the email that accompanies this video, obviously. So Ian, everyone, thank you so much for your time. And if you do have a question or comment to send in to us, please email them to marketinsights@bannionhill.com. And if you're watching us on the Banyan Hill YouTube channel, please make sure to subscribe to that channel so you get alerts when we post a video. And you can also just post a comment below in that video, and we'll be sure to aim to answer that for you. Okay, that's it for this week, Ian. Hope
Awesome.
You have a good
Thanks
week.
everyone for tuning in. We'll see you next week. Take care.